What are interest rates? We either love them or hate them depending on if we're lending money or borrowing money. Interest rates is what we are going to discuss on today's video. This is day 6 of 100 Days of Finance, where the entire goal is to give you more personal finance education in 100 days than most people receive in their entire lifetime. As always, my name is Derek and I got my degree in finance, so you don't have to. Let's get right into the video. So, what is an interest rate? Well, basically, interest rates are the percentage that lenders charge to borrowers for that use of money. Now, this happens for a couple of reasons. The first is time, which has value. This is known as time value of money. The second is the amount of risk. This dictates the value of that time. So while yes, interest rates can be seen as the profit for the lender, it is more so compensation for the risk and the time. Again, this is because of the concept known as time value of money. Now, I do have a full video on this concept coming soon, but here's a quick explanation. Time has a monetary value. That's because if you ask anyone if they'd rather have $100 now or in a year from now, the rational choice is always now. So the value of time is the amount of money someone must be paid extra to put off receiving that $100 for a year. Make sense? Now that amount is also different for different people. If you loaned your money to person A, who you knew for a fact would pay you back, you probably don't need as much incentive as if you loaned your money to person B, who has a track record of being late and not paying people back. That is why credit rating, along with collateral, affects your interest rate. You see, if person B, who sucks at paying people back, gave you, say, their watch to hold onto until they pay you back, while it might not completely lower the rate to that of person A, it can help you feel much more confident that you're going to get your money back. Because in a worst case scenario, while it might be a pain, you can always sell that watch to recover your funds. This is known as collateral. Now, believe it or not, this whole thing is also true when you are loaning your money. For example, in a savings account. The bank pays you interest as an incentive to keep your money with them. But that's also the reason why your interest payments are also so much lower. The bank, of course, considers itself much less risky, so it pays you less. Is that fair considering that banks have failed in the past? I don't know. Okay, now how are interest rates calculated? Well, interest rates are calculated based on the amount that is being borrowed, the length of time that money is being borrowed, and the risk involved in lending that money. Interest rates are usually expressed as an annual percentage rate, also known as an APR. This represents the total cost of borrowing that money for an entire year. When you borrow money, the interest that is charged is added to the principal value of the loan. That interest payment is calculated based on the amount that you borrowed and the time that you borrowed it for. So naturally, the longer the term of the loan is, the more interest you are going to pay. Similarly, the more risky that the loan is, the more that you are going to pay. Now, why do interest rates even exist in the first place? Again, it goes back to the fact that no one who is rational wants their money locked up for long periods of time without having access to it. But at the same time, some people need money now, like to buy a house, and some people don't, like when they put extra money away in a savings account. So interest rates exist to allow money to flow to where it is needed now, while at the same time compensating the person or the entity lending it. Here's the thing. Interest rates also exist to encourage savings and to discourage spending, or vice versa. When interest rates are high, it is more attractive to save money. When interest rates are low, it is more attractive to borrow money and spend money. This is how the Fed controls the economy, or at least tries to, by raising and lowering what is known as the federal funds rate. And yes, there is a video explaining that in depth coming very soon. Now, there are also different types of interest rates. There are fixed, there are variable, and there are compounding interest rates. Fixed interest rates stay the same for the entirety of the loan, while variable interest rates can fluctuate based on market conditions. Compound interest rates are rates that are calculated on both the principal and any accrued interest. Compound rates are very good when it comes to investing. When you hear that the stock market returns, let's say 8% per year, that might not sound like much, but if you don't withdraw your profits and let them compound, the next year you will be earning 8% not on the initial investment, but 108% of the initial investment. That is how compounding interest allows your money to grow extremely fast over longer periods of time. Now, let's talk about fixed versus variable rates. Fixed rates are popular with borrowers who want to have a predictable payment schedule and amount. The These are best for buying big purchases like houses. Variable interest rates, on the other hand, are attractive to borrowers who are willing to take a little bit of risk for a potential lower interest rate in the future. These are risky and should only be used when it is very clear that interest rates should fall in the coming couple of years. It's very hard to predict. Look, understanding interest rates is essential to making informed financial decisions. If you are borrowing money, knowing how interest rates are calculated and what they are will help you choose the best loan for your needs. On the other hand, if you are saving money, understanding how interest rates are paid will allow you to choose the best savings account. That second part, I feel like everyone ignores. Remember, sometimes you are the lender. Now in tomorrow's video, we are going to be discussing what the S&P 500 is as we continue 100 days of finance. So make sure to subscribe and hit the bell notification so you don't miss the next video. I hope this video was fun, informative, easy to watch, and enlightening. Again, my name is Derek and I got my degree in finance, so you don't have to. I love this stuff. It's been my passion for over a decade and I love being able to share that with you. I'll see you in tomorrow's video.